Greetings. My name is Bill Wood. I'm the economics editor for Plastics News. And today, I'm going to keep it real. It's the first week in October 2023. And just today, the yield on the 10-year Treasury note, according to the market, hit 4.8%. Now, if you adjust that for the prevailing rate of inflation at 3.5%, you get a real interest rate of 1.3%. The question is that restrictive or accommodative or neutral? Well, I guess that depends on who you ask. The Fed is worried that it may not be restrictive enough, so they're threatening to raise interest rates yet again. But if you look at the data, I have a different opinion. The overall rate of inflation or price increase in the US over the past year has been about 3.5%. But when you break that down into the two sectors, the goods producing sector and the services producing sector, it's two different stories. The rate of price increases in the goods producing segment of the economy is 0.7%. Now that's well below the Fed's target range of 2%. So mission accomplished, right? Not so fast. The services sector is running at a rate of just under 5% for price increases over the last year. Too high. Combined is 3.5. That's what the Fed's looking at. That's why they're threatening to raise interest rates again. The big problem with the services sector is the input of labor. Services is heavily reliant on or dependent on labor input as part of their costs. And as we all know, the cost of labor has been going up. It's about 4.5% across the economy over the past year. And then just this morning, we get a data point out of the job openings that it bounced back up substantially. Now that data is a little bit noisy and it's been volatile the past year, but bouncing back up, a job openings number bouncing back up at the present time is not going to give the Fed any comfort. So we have a very low rate of unemployment, which is what the Fed wants, but they have to lower job openings to keep a lid on the cost of employees and the employment cost index, and by extension, the cost of services. And so far, they haven't achieved that. So whether they can lower job openings without lowering the overall employment rate is yet to be seen. But that's their target, that's their goal, that's what they're trying to do. The problem is that the labor segment and the services sector is less sensitive historically to interest rate hikes than the goods producing sector. So the plastics industry, which falls firmly in the goods producing side, is struggling. They're getting hit by a double whammy. Number one, interest rates are already restrictive for the goods producing sector. We know that spending on goods has been flat for the past year. And like I say, the prices have been reasonably flat as well, less than 1% price increases. The service side is not flat, it's still rising too quickly, both the costs of services and the employment costs. So, and that's less sensitive to interest rate typically. So the Fed may think they need to raise them some more. That's a vice, that's a conundrum. I don't know how that's going to go, and I'm not going to predict. All I know is that the goods producing sector could use some relief in the form of lower interest rates, already plenty restrictive for them, already positive real interest rates for the goods producing side. But I don't see that happening just yet. The services side, maybe this is enough interest restriction to slow down demand for services, but that we have to see. I haven't seen that in the data, neither is the Fed. So we're at a crossroads here, and how this is going to turn out is going to be very important to people in the plastics industry going forward as far as their forecasts for the next year and beyond. I'm going to keep monitoring this very closely. This tension between services and goods and prices and interest rates has got a lot of the data and the trends doing things I've never seen before. So I'm watching it very closely, learning a lot. Happy to share it with you. That's my mission with these videos, and I hope you'll continue to stay tuned. The news isn't really very good yet, but it will get good. It's going to get good, and as soon as it does, I'm going to be amongst the very first to tell you that. So please stay tuned. Thank you for joining me this far.